Hello, I'm Sarah Allen and welcome to Livewire's The Pitch. Today, I'm joined by John Stover from Tribeca Investment Partners. We're going to be talking all things Asian credit. John, welcome.
Thank you.
So to begin with, why Asian credit? What do you love about investing in this space?
Yeah, sure. So I've been based in Asia since 2010. I'm from the US originally, moved to Singapore in 2010. Tribeca's had an office in Singapore since about 2015. And if you look at the market development over that period of time, Asia credit, the market size has grown by about 500%. But the amount of dedicated, actively managed capital focused on investing in the space just really hasn't kept pace. So what we see is, given that fast growth and the obviously lack of actively managed capital, there's an incredible amount of market efficiencies and alpha generation opportunities that we can take advantage of. And having invested across some different markets and regions, I've always felt like Asia credit was the market that was most ripe for alpha generation. And that's really what we try to capture with this fund. So if you look at Asia, the yields on offer in Asia are higher than what you see in other regions, just by virtue of having that emerging market label. Obviously there are some developed markets within the region as well, including Australia, which we do a lot of investing in as well. But by virtue of having that emerging market label, which a lot of the countries in the region are, they trade at higher yields for the same credit quality relative to developed markets. And so that's despite having lower default rates historically. And so that's a real mispricing that we try to take advantage of with this strategy.
Okay, and what are some of the key headwinds and tailwinds you're seeing across the Asian credit universe at the moment?
Yeah, so I'd say looking between the different countries within Asia, it's a real mix in terms of what's happening economically. So obviously a lot of people, when they think Asia, they just think China, right? And China, the economy there has been very challenged over the past several years coming out of COVID. They've obviously had a big property crisis. So I think a lot of people sort of paint Asia with this Chinese brush, but what's happening is very different in the other markets, in the other economies. And generally when we see trade war, that's obviously negative for what's happening within China, but it's actually positive for what's happening outside of China in the region. Because typically what we see is, you see manufacturing factories, they move from China to, say, Southeast Asia, India. We've seen Vietnam, Thailand, Indonesia all benefit from that. So that's, I think, a headwind for what's happening in China, but we really are more focused on the portfolio, what's happening outside of China. So we've always been very focused on Southeast Asia, India, Australia, different parts of other smaller countries within Asia as well. And so that, I think, a lot of people can look from the outside looking in, and sitting in Singapore, we sometimes forget this because we're living this day to day. But from the outside looking in into the region, a lot of people can kind of look at China and think of that as a headwind. But we actually think it's a tailwind for a lot of the companies in our portfolio that are based outside of China. And in terms of the rate cycle, I think that's been another interesting thing that's happened over the past 12 to 24 months. So we saw rates go in the US from 0 to 5.5% in 18 months, which was the fastest increase ever. And that obviously, when we're investing in fixed coupon bonds, which is predominantly what we invest in the portfolio, that's obviously a big negative for the market when rates rise that quickly. Now what you're seeing over the past 6 months, rates have topped out in the US. You see 5 to 10 year topped out close to 5% towards the end of last year. That's fallen from about 5% to 4.30 right now. And then we also see rate cuts happening on the horizon towards the end of this year. And so that headwind that we've seen over the past 12 to 24 months, that's turning into a tailwind that's going to be really positive for fixed rate debt.
So how is this influencing where you're investing or where you're avoiding for the coming year?
Yeah, so we're still staying very light on China. That's less than 10% of the portfolio. We've had higher allocations towards India, Indonesia, and Australia, and I'll go through those quickly. So India, it's a really strong structural growth story. So great demographics. It's much more politically stable than it has been in the past, and I think a lot of people have seen the election coming up later this year as sort of the biggest risk. But we've seen some state wins in the state elections for BJP, and we think that's a strong precursor to what's going to happen in the national election. So we think that structural growth story continues, and there's a lot of opportunities there. Indonesia is another big overweight for us that we've had over the past 1 to 2 years and continues to be. There's a really fascinating story that's happening there where traditionally it's been a natural resources exporter. And what they're doing is they're keeping a lot of those resources now within the country, moving increasingly downstream, starting to produce things like electric batteries that go into electric vehicles. And we think, again, that has a really strong demographic story as well. Australia, that's been a market that we've always done a lot of, actually. And Tribeca obviously having the Australian heritage. And that actually, the market's sort of moving towards us right now. And what I mean by that is there's been a new index that has started called the JP Morgan Asia Pacific Credit Index, whereas before it was just the JP Morgan Asia Credit Index. And the new index is including Australia and Japan. And so basically the market is going to move more towards what we're doing. And I think we're going to see increased inflows into Australian credits by virtue of that.
Okay, is there anything that you think the market has missed or hasn't fully appreciated when it comes to Asian credit?
Yeah, sure. So I think that dynamic that I talked about before, which is, from China versus the rest of the region, there's a difference between what's happening economically and what's happening in markets. And so again, what we see is generally when trade war kicks off, that's actually a negative for China, but a positive for the rest of the region. And if you look at PMIs in Asia ex-China, they're actually the highest in the world, relative, higher than what you see in the US, higher than what you see in Europe. So I think that's something that is a nuance that people don't pick up on, but also from a markets perspective, often when people are, from the outside of the region looking in, when they think negatively of China, they just sell their entire Asian exposure. But so often that can be a negative for the market prices that we see in Asia excluding China. But that's a great opportunity, right? I mean, what we look for as an investor is opportunities that are mispriced. And so whether companies are doing better economically because of trade war, but the market prices of the securities are going down, that's an amazing opportunity for us. And that's something that we are going to try to take advantage of in the next 6 to 12 months, and certainly something that we have over the past 6 to 12 months.
Okay, thank you so much for sharing those insights with us today. If you've enjoyed watching this interview, please subscribe to Livewire's YouTube channel. Thank you for watching.